Hey everyone, this week I'm going to focus on the commercial real estate debt market a little bit. The health crisis and the recession it spawned have taken a toll on investor activity. Commercial real estate transactions in the second quarter declined by about 60% compared to 2019. That decline reflected both investor caution as well as the many logistical hurdles that were created by the shutdown of the economy. Given the fact that the economy shrunk by $2.1 trillion that quarter and 20 million jobs were lost, it makes sense for activity to decline. But the economy has recovered a lot of ground since April. A little more than half of the lost jobs have been recovered. Retail sales are now at a new peak, and it looks like the third quarter will deliver a sizable economic bounce. This recession is very different from the global financial crisis. Although economic losses in this recession have actually been greater than what was experienced in the financial crisis, it looks like the recovery will be considerably faster, assuming we don't have another major setback. Another big difference is the capital market liquidity. Many investors have deep war chests of capital, and lending is readily available for most property types. In addition, mortgage rates are exceptionally low. During the financial crisis, bank reserves were very low, and capital markets were nearly frozen, and then they thawed only very slowly. Current liquidity is elevated, though selective, with local, regional, and national banks dominating the lending market. Lending is broadly available for industrial properties, medical office, and multifamily properties, which are supported by Fannie Mae and Freddie Mac. Lending on office, self-storage, and seniors housing is more cautious, with terms and availability being scrutinized on a case-by-case basis. The segments facing the tightest lending climate are hotels and shopping centers. Interest rates on real estate loans have pursued the 10-year Treasury in its fall, and debt can be found ranging from the upper 2% range to the high 3% range, depending on property type, location, term, borrower strength, etc. As a result, many properties can be purchased with particularly strong levered yields right now. The yield spread between the cap rates and the 10-year Treasury has opened to its second widest level on record. The spread for apartments is matching its greatest historical spread, while the yield spread has reached its widest point ever for office, self-storage, and hotels, although financing hotels is very difficult right now. This offers investors a very rare investment climate. Looking back in time, periods with widened yield spreads represent classic opportune investment periods. It's a window like we had in 2002 and 2011 that many investors in retrospect wish they had more fully capitalized on. The fact that debt market liquidity is strong is different from 2011 and opens an array of options. The levered returns available today, some of the best on record, offer investors with a long-term perspective that looks past the short-term health crisis a strong return horizon. Competition for assets in the fourth quarter will likely begin to intensify as more investors return to the market, and that could potentially put some new pressure on cap rates for the most favored property types in metros with a strengthening growth outlook. More real estate investors are beginning to look forward, locking their eyes on the horizon.